hammer on Paytm Payments.
Restrictions on Paytm Payments Bank have indeed.
Hello everyone, I am Tirthankar Roychowdhary, your friend and guide for the Civil Services exam preparation. On 31st of January, the Reserve Bank of India came down heavily and issued directions against Paytm affiliate Paytm Payments Bank that practically stopped it from offering all its core services, including accepting deposits or top-ups in any customer accounts, wallets, FASTags or other instruments after 29th February. This strong stance by the RBI has sent jitters across the Indian fintech sector. In this video, we will try to understand the entire issue of Paytm purely from the perspective of the Civil Services exam. So without further ado, let's get started.
India is celebrating Constitution Day today.
Finance Ministry expects India's growth to be
the new Parliament building in
In the year 2000, after receiving a loan of 8 lakh rupees, Vijay Shekhar Sharma, or VSS as he is popularly known in the entrepreneurial circuit, founded Paytm's parent organization 197 Communications, which offered digital goods and services. The company was doing fine, but not good enough for its founder. So in the year 2010, with an initial investment of $2 million, Sharma launched Paytm, an acronym for Pay Through Mobile, which started as a prepaid mobile and DTH recharge platform. In 2013, Paytm expanded its operations, adding debit card and post-paid mobile payments. However, Sharma completely disrupted the market in 2014 when Paytm introduced its wallet. With the single wallet now, one could get his Metro card recharged, pay his electricity bill and water bill. It was an instant hit. Sharma wanted everybody to pay through mobile. The Paytm app got validation when institutions like Indian Railways and companies like Uber added it as a payment option. It was a digital revolution. Paytm's user base grew rapidly. By 2014, nearly 11 million users were using Paytm. That number grew drastically to 100 million by the close of 2015. So Paytm was becoming popular day by day, but the best for Paytm was yet to come. Till 2016, cash was the real king in the Indian market. However, all of that changed on 8th of November 2016 when the Honorable Prime Minister announced that the rupee 500 and 1000 currency notes will cease to be a legal tender from that date. People were left with no option, so they turned to digital payments. Consequently, digital payments surged, and this was the big breakthrough for Paytm. Demonetization made Paytm a household name and necessity. In fact, the tagline of the company was "Ab ATM nahi Paytm karo." After demonetization, millions of merchants signed up for Paytm. They all became Paytm clients and Paytm issued them QR codes. These codes were linked to their bank accounts. One could just scan the QR and pay. It was easy and simple. No requirement of cash, no waiting for change, a true game changer. Consequently, more and more people signed up. The cab drivers, the street vendors, the repair shops, almost every business started using Paytm app. Consequently, the Paytm's user base grew rapidly. By 2017, it became the first payment app in the country to achieve 100 million downloads. By 2021, Paytm was handling nearly 1.2 billion transactions on a monthly basis, and its user base surged to 150 million active users. Today, Paytm has expanded its business into several services like ticketing for movies and flights, gold sales, insurance, bank deposits, and remittances. Paytm was doing very well, and its investors like Ant Group and SoftBank were really happy with its performance, so they decided to take the company public. In the year 2021, Paytm created history by organizing India's largest and most successful initial public offering ever. Paytm's IPO exceeded Coal India's IPO that was conducted in the year 2010. Back then, Coal India was successful in raising rupees 15,200 crores from the investors. Paytm surpassed that in 2021. Paytm was successful in raising rupees 18,300 crores from the investors at a valuation of $20 billion. As per reports, after the successful completion of the IPO, Vijay Shekhar Sharma, the founder of Paytm, broke into tears while delivering his speech at the Bombay Stock Exchange. So everything was going great for Paytm. Then why this RBI clamp down now? To understand the crux of the problem, we must look into the functioning of a Paytm subsidiary called the Paytm Payments Bank Limited. But before we dive into the details of the functioning of the Paytm Payments Bank, let's try to understand the difference between a payments bank and a regular bank. Payment banks are a specialized type of bank set up by RBI in 2014 on the recommendations of the Nachiketa Moore Committee. The idea behind the introduction of these banks was to promote financial inclusion by offering basic banking services to the unbanked and the underbanked population, like migrant workers, low-income households, and small entrepreneurs. These banks have to register like a public limited company under the Companies Act 2013 and obtain a banking license under the Banking Regulation Act 1949. These banks are also regulated under the Reserve Bank of India Act 1934, Foreign Exchange Management Act 1999, and Payment and Settlement Systems Act 2007. The minimum capital required to start a payments bank is 100 crores. For the first 5 years of its operation, the shareholding of the promoters cannot dip below 40% of the total shareholding. These banks are also allowed to attract foreign investment. Foreign investors can invest in these banks as per the FDI rules applicable to private banks in India. However, the payment banks are not similar to ordinary banks. They function under severe limitations. Let's take a look at these limitations now. The payment banks can open only savings and current accounts. The maximum balance of deposit they can have in their account is only rupees 2 lakh. Earlier, it was rupees 1 lakh. These banks cannot accept deposits from non-resident Indians. These banks are not allowed to lend money or offer credit services. These banks are allowed to issue ATM or debit cards to their customers, but these banks are not allowed to issue credit cards. Just like other commercial banks, payment banks have to maintain cash reserve ratio or CRR with the RBI. They are also required to invest a minimum 75% of their demand deposit balances in statutory liquidity ratio or SLR eligible government securities or treasury bills. Since these banks cannot lend, they are also exempted from the priority sector lending regulations that typically apply to traditional banks. The Paytm Bank is a payments bank that came into existence in 2017, and in the same year it got a banking license. However, recently RBI has placed major restrictions on the functioning of the Paytm Payments Bank, citing, and I quote, persistent non-compliance and continued material supervisory concerns. In simple words, the Paytm Payments Bank has regularly violated the rules and guidelines set up by the RBI for the banking sector. That is the reason why the Paytm Payments Bank has come under the scanner of the RBI. RBI discovered that there exist lakhs of accounts in the Paytm Payments Bank which are non-KYC compliant accounts. KYC is short for Know Your Customer. It's a device through which banks establish the identity of their customers. Non-KYC compliant account means that the bank has no idea who is operating the bank account. Further, in several cases, a single PAN card was used to open multiple bank accounts in the same bank, which is again not permitted as per the rules of RBI. Moreover, it has been found that in several cases, the total value of transactions ran into thousands of crores, which raises serious concerns about money laundering. Money laundering is an illegal activity by which dirty or black money is converted into legitimate or white money. RBI has informed the Enforcement Directorate and other government agencies about the irregularities that are going on in the Paytm Payments Bank. Another major problem is the Paytm Payment Bank's dependence on its parent entity 197 Communications for IT infrastructure. This dependence has raised data privacy concerns because there is every possibility that the data which is submitted to the Paytm Payments Bank is being shared by all the entities that function under the umbrella of 197 Communications. The Honorable Supreme Court in the Justice K.S. Puttaswamy vs. Union of India 2017 case upheld right to privacy as a basic fundamental right under Article 21 which cannot be violated. What is more concerning is the involvement of Antfin, an affiliate of Alibaba Group, as an investor in 197 Communications. Increasingly, the Chinese companies have come under the radar of Indian agencies for their activities which have been considered prejudicial to Indian interests. It is alleged that these Chinese companies, they collected data from India and then they use that data against Indian interests. It is not the first time that the Paytm Payments Bank finds itself in murky waters. In fact, in June 2018, RBI prohibited the Paytm Payments Bank from opening new bank accounts. The bank responded by submitting a compliance report, and by the end of that year, that ban was lifted. Things unraveled further in 2021 when RBI slapped a fine of 1 crore rupees over Paytm Payments Bank, saying that the bank has submitted false information. By the end of 2021, matters became worse. RBI found more irregularities, data security, and money laundering concerns. That's why RBI issued directions against the Paytm Payments Bank and asked it immediately to stop onboarding new customers. The RBI also called for an independent audit by an external agency. That audit happened, but RBI was not happy with the audit report. It said that the Paytm Payments Bank is not serious about the irregularities and not taking corrective measures. Therefore, in October 2023, RBI slapped another fine on Paytm Payments Bank. This time, the amount of the fine was 5.3 crores. So 6 years, multiple warnings and 2 fines. Yet, the Paytm Payments Bank did not set its house in order. Therefore, in 2024, RBI said while imposing restrictions on the Paytm Payments Bank that it has found Paytm Payments Bank of persistent non-compliance and continued material supervisory concerns. Although the RBI Governor, Shaktikant Das, said that RBI takes all its decisions after due consideration and analysis and there will not be any review of the Paytm Payments Bank decision, recently RBI has given a fresh grace of 15 days to Paytm Payments Bank to set its house in order. Meanwhile, Vijay Shekhar Sharma, the founder of Paytm, took to social media to address the concerns of every Paytm user. However, his assurance could not stop the meltdown of the Paytm stocks. Paytm grew rapidly because it was simple to use and it provided opportunities for everyone. It was indeed revolutionary. But Paytm committed one big mistake. It did not play by the rule book. The Paytm fiasco is a good lesson for every entrepreneur in India that irrespective of how big you become, if you take the rules for granted, the law will catch up. The Paytm Payments Bank episode is a test for not only Paytm but for the entire Indian startup ecosystem. India has more than 100 unicorns. These unicorns have contributed significantly to Indian growth. If we eliminate these unicorns, then the Indian growth story does not look as promising as it looks today. Further, such kind of episodes hurt business sentiment in the country and impact foreign investments. Therefore, RBI and the Paytm must sit together and find a way to resolve this crisis. So this was my take on the Paytm crisis. If you have learned something substantial, hit the like button, and for more such videos, subscribe to the channel. That's all from my side, folks. I'll see you in the next one. Thanks for watching.